So what we're trying to do here is we're trying to determine what we're trying to determine an appropriate allocation of labor to each order that we have. Because we're dealing with multiple people within the production process, um, and there are different rates, and you have overtime in play, and you have benefits in play. It's really difficult to allocate costs directly to each order. And so this is a form of standard costing where we allocate to each project for cost of sales purposes. We'll allocate an amount per hour, but it's a static amount. So in the item, remember we've said labor is, I don't know what the number is, $15 an hour or whatever it is. And we think that's going to take an hour and a half for this particular item, and so it's 15 times 1.5. For costing purposes, that then is our cost of labor. But our actual cost of labor is a little different. That person might be working on that project in overtime. In other words, their actual cost is 1.5 times, uh, what we might have assigned in the build assembly form, as one example. Um, so we have this labor variance account as a means to capture the difference, and then we can review that difference periodically, monthly, quarterly, whatever that cadence is, and make a decision as to whether or not the rate or the amount of labor that we're allocating to each project is sufficient, insufficient, or excessive. And it's this labor variance account that will tell us that. So I'll do debits and credits and tell me if I lose you, because it's very easy for me to kind of just forge ahead and everyone's going, I have no idea what he just did. So the entries in the books, what we do is let's start with the actual production. And you're going to have to forgive my spelling. I like to spell the South African way. So in production, we will have direct labor that takes place. And let's assume that, and we'll keep it simple. Let's just assume it's 1 hour, and we'll have the rate at, say, $15 per hour. So that means that the cost of sales, or the amount that gets included in cost of sales for an order, is going to be 1 hour at $15. So in other words, $15. Um, in our payroll, um, that employee gets paid for that hour. Um, let's just say with benefits, employer taxes, etc. Let's just assume it is actually $14 per hour. So what that means is that um, the expense that we're incurring is $14, right? And so the reason why this is 15 is because we were estimating. We didn't know exactly what it was going to be. We thought maybe we would always use employee, let's call this employee number two. We thought we might always use employee number one, who gets paid $15 an hour, but we end up using employee number two, who only gets paid $14 an hour, as a possible scenario. So in our books, we're going to have the system is going to do some entries for us. And when we sell this item that took us an hour to make at $15 standard cost, – we'll just put your standard cost. 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 – we'll just put The system is going to go and say, all right, I have to debit cost of sales with the $15. And because for every debit there has to be a credit, that's the way accounting works, it goes and credits labor variance account for $15. Okay. Then when we run our payroll, the what the payroll system should be doing, the way we've set it up for accounting purposes, the payroll entry should be debiting labor variance with what we pay, so $14. And of course, it comes out of our bank account, right? So it comes out of cash. And so that's a credit out of cash. So these are the two entries that happen that the system would do automatically. Now, when we go and look at our GL labor variance account, we will see that we will have two entries. We will have the assembly build entry. Yeah, we use symbols in South African English. We will have an assembly build entry, and it will show up in that account as a negative, and that's the 15. And then it will have a payroll entry, and that is a debit, so it will show up in this labor variance account as a positive number, so 14. So the balance on this account would then show at the end of the period the sum of these two things being a negative or a credit balance of $1. That's what you're seeing right now. But the credit number is higher because we don't see any of these other, we don't see the payroll entries coming in yet. So that's something we have to clean up. But this is what it would then look like. So when we see our financial statements, what we will see on the P&L, we will see COGS of $15, right? Let's do some other numbers here. You'll also see sales. Let's just say we sold it for 20. And you'll see a gross profit then of 5. You would see gross profit of 5, right? But what we've done is that we've got the labor variance account. And so included in cost of sales, we've also got labor variance of the 1. Is everybody still with me? Are you seeing where I'm getting these numbers from? So we would show a gross profit of $6. Because what this labor variance is essentially doing is it's saying, no, the standard cost of 15 was too high. It was only 14. And so it adjusts it down accordingly. So once you add these numbers together, you get to the actual correct cost of sales. But because you don't know before you do the production run exactly what their labor rate is going to be, you're using a standard $15. The labor variance account makes sure that it adjusts to the actual total cost. So what happens then is that when you look at a report and you say, how much did each order, what was the gross profit I made? That's essentially what you would call a expected gross profit based on the standard cost, the fixed cost of $15 an hour. That's my gross profit. Then for that order, but then when you look at your financial statements, you might see a slightly higher or slightly lower gross profit because now it's adjusting for what the actual labor expenses were that you just didn't know at the time that you were doing the assembly build, what those were going to be. So when you see a negative or credit balance on labor variance, what that is essentially telling you is that we put too much labor cost into each order. Our labor cost in each order is higher, what that we put in is actually higher than what our actual was. The reverse is true. If you were to see a positive balance or a debit in your labor variance account, that means that you're not putting enough labor into each order. So you actually have to increase your labor rate at some point. So the labor variance is a mechanism for you to gauge, am I applying enough labor, too much labor, or too little labor cost to each job? That's what the labor variance account is telling you. It's telling you that if it's a credit balance, the labor rate that you used over all your jobs, over all the orders, was higher than what it needed to be. So if you're using the highest labor rate, let's just say that that's 15 for all jobs, but most of the jobs end up being done using labor at 14, then you are going to have an over application of labor costs. So you will see a credit balance. A credit balance in this variance account is actually a good thing, because that means that you are applying more labor than what you should. Therefore, you potentially, if you're basing your selling price on a function or a percentage or a multiple of your costs, that means you are charging your customer based on a slightly higher input cost, but end up at a lower actual input cost. So therefore, you actually make a little bit more profit. So because you don't know at any given time which blanket, which order is going to be done by which person at which labor rate, you it's always best to use a fixed standard. In this example, $15. And the variance then, comes in, and it ultimately at the total aggregate gets you to the right correct gross profit. But by order, if you were to look at each individual order, the gross profit will be, maybe a little higher or a little lower than what that actual is, but that is the nature of using a standard, because you just don't know. So this entry at your general ledger level is what corrects it so that the total is accurate. I mean, in an expanded standard costing environment, I'll just give you a little insight. Very large factories, think of any kind of factory out there that you imagine. They use standard costings even down to the material pricing. And so they will have material price variance as well as labor cost variance. And all these variances then are used in very large manufacturing environments by the cost accountants that work there, is for them to keep track of what those variances are. And if they kind of go out of line with what their expectations are, then they go back and they go and investigate what's going on. It helps them track if there's any kind of issues. One of the other things that comes into play with this is that your labor variance could, in fact, be telling you whether and to what extent production workers might be taking longer than what you're expecting, right? So if you have a very large labor variance, it might also be that we're not doing each order at the number of hours that we would expect. Because if you're only expecting that to be 1 hour and you're expecting your cost to be, $15, but your cost ends up being $30 because it actually took 2 hours, that will also start to show up in the labor variance account. Yeah, I mean, taking the position of let's use the higher rate is the conservative approach, because that means that you're estimating that your estimate cost is always going to be no higher than this amount, because I'm using the highest labor rate in play. I would hope that this ends up getting done by somebody at a lower labor rate, in which case my actual profit is higher than what I'm expecting. If you take the view and you say, well, I'll use an average labor rate, then you're always at risk that you're going to end up with lower profit on each order when it does end up being done by somebody at the highest labor rate. You probably never want to use the lowest labor rate because then you're always likely to be making less money than what you're expecting. So using the higher labor rate is the conservative approach by saying my labor shouldn't be higher than this. Therefore, the profit that I'm estimating on this order should be the minimum amount of profit I would expect to get.